Welcome to Accrual Accounting Fundamentals and Terms, a beginner's guide to basic accounting terms and concepts. I am Olivia Crouch from Team Local Government Support here at the State Auditor's Office. This training is going to stick to intro-level information. So if you're not very familiar with accounting, this training is for you. And if you are familiar with accounting, this will mostly be a refresher. We're going to start with accounting vocabulary. We will define some of the most common terms used in accounting, and then we'll go over the basics of accrual accounting. Now, I'm going to cover generic accrual accounting, not governmental accounting. That will be in a different training. After we learn about accrual accounting, we'll put it into practice by completing some journal entries, and then we'll use those journal entries to create financial statements. Let's get started with some basic accounting terms. First up is defining the bases of accounting. There are several different ways accounting can be done. We'll talk about 3 of those. The first is normal accrual accounting. This is what is typically taught in accounting classes. Under this basis, you record revenue when it is earned and expenses when they are incurred, regardless of when the cash is exchanged. Then we have governmental accounting. In Washington State, there are 2 bases of accounting that local governments can choose from. One is cash basis, which is basically what it sounds like. Transactions are recorded when the cash is received or dispersed, with some special rules. Next is GAAP, Generally Accepted Accounting Principles. This is accrual accounting with some additional special rules. Let's look a little closer at governmental GAAP accounting. Under governmental GAAP accounting, there are 2 ways that accounting is done. The first is full accrual, which is really similar to the normal accrual accounting. This is the accounting used in proprietary and fiduciary fund statements. It's also how the government-wide financial statements are prepared. This is the basis of accounting that this training will focus on. However, in governmental accounting, we also have what we call modified accrual accounting. This is the basis of accounting used in governmental funds. This accounting is very different from full accrual accounting and has its own training video, so we will not talk very much about modified accrual accounting in this training. Before we dive into the accounting, let's go over some more basic terms that you should be familiar with. Sometimes people use the terms bookkeeping and accounting interchangeably, but they really do mean different things. Bookkeeping is the act of gathering and recording daily transactions. So that's like collecting invoices and entering that information into the accounting system. Financial accounting goes even further. It's not only recording the transactions, but it's also summarizing and reporting. That would be like preparing monthly or annual financial statements. It also includes analyzing and interpreting the financial data. So looking at the revenue or expense trends and determining why they changed over time. Financial accounting is really important because it offers accountability and transparency by reporting the financial information in a way that can be read and interpreted by others outside of the accounting department. For example, a governing board, investors, or citizens can look at the financial statements and understand the current status of the organization. Next, we have account. Within the accounting world, this means a way to categorize and track financial activities. Some account types that you might be familiar with include assets, liabilities, expenses, revenues, and so on. A ledger is the book or software that contains different accounts. This used to be a physical book where accountants would record each account and the transactions within those accounts. Most governments are now using software to track all their financial activity. You may hear this referred to as the general ledger, or GL. Some governments may even have sub-ledgers for specific activity. For example, they may have a capital asset ledger where all capital assets are recorded. The sub-ledger information is then summarized and recorded into the general ledger. Transactions get entered into the ledgers via journal entry, sometimes also called journal voucher. The journal entry is just the transaction information translated into a specific accounting format, which we'll practice later. We use what we call double entry accounting, which means every single journal entry impacts at least 2 different accounts. The journal entry has equal and opposite effects on those 2 accounts, which are recorded as debits and credits. Said another way, the journal entry debits must equal the credits. The debit is the left side of the journal entry, and the credit is the right side. Debits will increase the asset, deferred outflows, and expense accounts. However, it has the opposite effect on other accounts. So that means a debit will decrease liabilities, fund balance, net position, deferred inflows, and revenues. Credits are the exact opposite. So if you record a credit in a liability account, it will increase the liability balance. Credits also increase fund balance, net position, deferred inflows, and revenues. However, credits will decrease assets, deferred inflows, and expense accounts. You may be familiar with the accounting equation. Assets equals liabilities plus owner's equity. In this equation, everything on the left side of the equal sign has a debit balance, meaning debits increase assets while credits decrease them. Everything on the right side of the equal sign is a credit balance. This means if you credit liabilities or owner's equity, you increase them. But if you debit a liability or owner's equity, you decrease them. Governmental accounting is special, so its equation is different. For starters, there are no owners in government. Because of this, instead of saying owner's equity, we say fund balance or net position. Governmental accounting also has some additional accounts that are not found in traditional accounting. These are called deferred outflows and deferred inflows. So let's take a look at the governmental accounting equation. Let's start with the classic accounting equation of assets equals liabilities plus owner's equity. Let's replace owner's equity with net position and fund balance since we have no owners in government. Next, we are going to add those additional accounts, the deferred outflows and deferred inflows. Now our final equation is assets plus deferred outflows equals liabilities plus deferred inflows plus net position and fund balance. So what are each of these accounts? Let's look at each one a little closer. Starting with assets. Assets are resources with 2 characteristics. 1, they have present service capacity, and 2, the government controls it. Present service capacity means that the asset can be used to provide services or enable the government to fulfill its mission. Control means the government can utilize the asset and determine the nature and manner of its use. Cash is a significant asset that has both characteristics. It provides present service capacity because the government can spend it to provide public services, and the government controls it. They get to decide its nature and manner of use. For example, they can choose to invest it or to spend it on fixing the roads, or to spend it on a new city hall, or many other things. Another example would be capital assets. These are assets that are expensive and will benefit the government for more than 1 year. This includes things like buildings, roads, cars, trucks, snowplows, and even parks. Since the government is responsible for providing park services, and the park is being used directly by the public for that service, that's the present service capacity. The government also controls the asset, the park, since they can choose how the park is used. For example, they can set specific hours the park is opened. They get to decide whether to use the space for a playground or a splash pad, tennis courts, walking trails, or any other various use. Deferred outflow is an account found only in governmental accounting. This is the consumption of assets that's applicable to a future reporting period. That means assets were used today that will benefit a future year. Since this is just an intro to accrual accounting and not a deep dive into governmental accounting, we won't go into more details on this. For now, you should just know that governments have special accounts that are not used in traditional accounting. Next are liabilities, which are obligations to sacrifice resources that the government has little or no discretion to avoid. Generally, liabilities are legally enforceable. Examples include wages or accounts payable. An employee or vendor provides services to the government, and the government is legally required to pay them for those services. So until the government makes that payment, they have a liability. Another example are bonds or loans payable, where the government borrows a lot of money and then is legally obligated to repay it over time. The government reports a liability for the portion of the bond or loan that has not been repaid yet. Similar to deferred outflows, deferred inflows are found only in governmental accounting. This is the acquisition of assets applicable to a future period. That means the government received something that will benefit them in the future. For the purposes of this training, I just want you to know that this account exists and it's unique to government, but we won't be covering it in detail today. Now that we've covered asset and liability accounts, we need to talk about contra accounts, which are negative accounts. For example, a contra asset account is a negative asset account. A contra asset account will reduce its related asset account. A common contra asset account is an allowance for uncollectible amounts. When a government has a receivable asset, meaning someone else owes them money, the government makes an estimate of how much they won't be able to collect because the other party is unable to pay them. This estimate is called an allowance for uncollectible amounts, and it reduces the total receivable amount reported. Another contra asset account is accumulated depreciation on capital assets. The accumulated depreciation is subtracted out of the capital assets to show net capital assets. And we'll walk through an example of this in our journal entries later. We also have contra liability accounts, which are negative liability accounts. Just like contra asset accounts, the contra liability accounts are combined with the related liability account to reduce it. An example of that would be a discount on bonds payable. Almost done with account types, only 3 left. Net position and fund balance is the residual amount of all previous balances. Another way to think of the accounting equation is assets plus deferred outflows minus liabilities minus deferred inflows equals the net position and fund balance. Remember that fund balance and net position is mathematically similar to owner's equity in traditional accounting. Revenues are an acquisition of assets applicable to the current reporting period. This means the government provided a service and acquired an asset.
Expenses are a consumption of net assets applicable to the current reporting periods. This would be like the government spending cash, which is a consumption of an asset to provide services to citizens.
Now that we've covered all the account types, let's take a look at their normal balance, which is the balance an account should have. What I mean by that is an asset account should have a debit balance. That means if you debit the asset, it increases. On the other hand, a liability account has a normal credit balance. So if you credit a liability account, it will increase it. Assets, deferred outflows, and expenses have normal debit balances. A debit transaction increases these accounts, but a credit will decrease it. Liabilities, deferred inflows, fund balance, net position, and revenue accounts have a normal credit balance. That means a credit transaction will increase these accounts, but a debit will decrease them. Now that we know the major account types, we'll dive a little further into accrual accounting and how specific accounts are used in accrual accounting. Starting with revenue. Under accrual accounting, revenue is recorded when it is earned. It does not matter when the cash payment is received. So let's say a business provided a service in December, but they are not paid until January. The month the revenue was earned was in December. That's when they did the actual work and fulfilled their part of the agreement. So under accrual accounting, they record the revenue for that transaction in December because that's when they earned it. It does not matter that they weren't paid until a month later. Similarly, expenses are recorded when they are incurred rather than when it is paid. So let's say a business orders supplies and they receive them in June, but they don't pay that invoice until July. The expense is recorded in June because that's when the expense was incurred. June is when they received the supplies and when the other party completed their portion of the transaction. So that's when the expense is incurred. In addition to revenues and expenses, there are also other gains and losses, which are very similar to revenues and expenses. One example of this is investment gains and losses. Just like revenues and expenses, these gains and losses are recorded when they are earned or incurred, rather than when the cash is received or paid. When talking about investments, the gains or losses can be either realized or unrealized. A realized gain or loss is when you sell the investment. At that point, if the sales price is more than what you originally paid, you have a realized gain. A realized loss is when the sales price is less than you originally paid. It's called a realized gain or loss because the transaction actually happened and was realized. An unrealized gain or loss is when there's a change in the fair value of the investment. This is called unrealized because you have not sold the investment yet, so you haven't actually experienced or realized the gain or loss. Now, even though we differentiate between realized and unrealized gains when describing investments, for reporting purposes, realized and unrealized gains are reported together on the financial statements. Let's look at an example. You purchase an investment on March 1st for $5,000. At the end of March, the fair value is $5,500. You have not sold the investment at this point, so the increase in fair value is an unrealized gain of $500. You report an investment gain of $500 in March. Then on April 15th, you sell the investment for $5,750. Now that the investment is sold, you realize the gain. The difference between the sales price and the purchase price of $750 is a realized gain. However, you reported $500 of this gain back in March as an unrealized gain. So in April, you're only reporting an investment gain of $250. Now we'll cover some of the most common assets. First is cash and investments. This is recorded as an asset when you have it or when someone is holding it for you, like a bank or an investor. Receivables are an asset that is recorded when someone else owes you something. This can be short-term, as in they will pay you next week, or it can be long-term, as in it will take them over a year to repay the full amount owed. Receivables get recorded when you have the right to collect it. So if you provide someone services and they promise to pay you next month, you record the receivable after you perform the services, because now you have a right to collect that amount. Capital assets are an asset that will benefit you for many years. This includes cars, your house, or equipment like a tractor. In government, this also includes things like roads, bridges, parks, some office furniture, and more. Instead of reporting an expense when the item is purchased, the asset is capitalized. Then you recognize an expense over the asset's life. This way, you are recognizing an expense as the asset gets used up. This expense is called depreciation. Let's say a government purchased a car for $30,000. And they will use it for 5 years. There is no salvage value, meaning at the end of the 5 years, the car will be worth $0. Instead of recording a $30,000 expense, the government reports a capital asset of $30,000. The cost of the car is then recognized over its useful life. Since the car cost $30,000 and will be used for 5 years, the government is using up about $6,000 of the car each year. Each year, they will recognize an expense of $6,000. That's called depreciation expense. This takes us to the next account called accumulated depreciation. Accumulated depreciation is the cumulative total of depreciation expense that has been recorded for an asset at a certain point in time. In our car example, in year 1, they recognized $6,000 of depreciation expense. So the accumulated depreciation at the end of year 1 is $6,000. Accumulated depreciation is a contra asset account. So it is a negative asset account. It reduces the related asset. That means at the end of year 1, the net asset value is $24,000, which is the original asset amount of $30,000 minus the accumulated depreciation of $6,000. In year 2, they recognize another $6,000 of depreciation expense, which increases the accumulated depreciation to $12,000 at the end of year 2. The net asset value is now $18,000, which is the asset account amount of $30,000 minus the accumulated depreciation of $12,000. And this goes on for all 5 years until the car is completely used up. Another type of contra asset account is the allowance for uncollectible amounts. This is an estimate of the amount that will not be collected due to failure to pay. So let's say in 1 month, a city issues speeding tickets totaling $10,000. Based on their past collection experience, the city usually only collects about 30% of what they're owed. Most tickets are uncollectible. That means they estimate 70% of that $10,000 will not be collected. So they record an allowance for uncollectible amounts of $7,000. Because this is a contra asset account or a negative asset account, we combine it with the related asset, the receivable account, to get a net receivable of $3,000. Now we'll discuss liabilities. Accounts payable are when you owe somebody else. These are typically short-term. Someone provided you supplies or services and you haven't paid them yet, but you will soon. These liabilities get recorded when you have an obligation to pay someone else. You are obligated to pay after they've delivered the goods or performed the service. Long-term debt is when you have borrowed money that will be paid back over time. In a personal setting, this would be like taking out student loans or a house loan. The bank loans you the full amount up front, and you will repay them over time. You have a liability for the entire amount of the loan at the beginning, and then the liability is reduced as you make payments. Governments also take out loans or bonds for really big projects that would be hard for them to pay all at once. Some examples include building a new city hall or a new road project. The government records a liability for the full amount borrowed. They reduce the liability as they repay the debt. Sometimes when a government issues bonds or loans, it's issued at a premium or a discount. A premium is when they receive more debt proceeds than they are required to repay. For example, a government might issue a bond for $1 million, but they actually received $1.1 million. The $100,000 is a premium. The government is still only required to repay the face value of $1 million. However, for reporting, the face value, the $1 million, and the premium of $100,000 are added together to report net debt of $1.1 million. The bond premium is amortized over the debt repayment period, and it reduces interest expense. On the flip side are discounts. This is when the government receives less proceeds than the face value. For example, if they issued a bond with a face value of $1 million at a discount of $100,000, they only get $900,000 in cash. They are still required to repay the full $1 million though. This discount is a contra liability account or a negative liability, so it reduces the related liability account. The government reports a net debt of $900,000. The discount gets amortized over the debt repayment period, which increases the interest expense. The final liability we'll talk about is unearned revenue. This is when you receive a payment, but you haven't earned it yet. You now owe someone services or supplies, and since you owe someone something, you have a liability. Let's say you have a printing business and a customer orders some posters. They pay you up front in December, but you don't complete the job until January. In December, you report an unearned revenue because you have received cash without performing the promised work. You owe the customer those posters. Then in January, you report the revenue since that's when you did the work and that's when you earned it. Now that we're familiar with the most common accounts, let's practice using them in some journal entries. When completing journal entries, one helpful tool are T accounts. They are called T accounts because you draw a line across the top and down the middle, making a T shape. On the left side of the T accounts is the debit column. Regardless of what type of account you're using, the left column is always the debit, and the right column is always the credit. As you make journal entries, you fill in the T accounts with the amounts from the transactions. Remember earlier when we talked about normal account balances? An asset has a normal balance of debit, so that means a debit will increase the asset account, while a credit will decrease it. Same for the deferred outflow and expenses, since their normal balance is a debit. On the other side are those accounts with normal credit balances. These are the liabilities, deferred inflows, fund balance, net position, and revenue accounts. If you credit these accounts, you increase them, while debits decrease them. We will be using these T accounts as we go through the journal entries. The first transaction is a customer paying cash for service. Now we translate this information into a journal entry. Think back to the beginning of this training. We said that we use double entry accounting, which means we know at least 2 accounts will be impacted, and debits must equal credits. When we have a transaction, we need to think about what accounts are impacted. We received cash for performing a service. Receiving cash means our cash balance increased. We know that cash has a normal debit balance. So to increase it, we need to debit cash. What about the other side of the journal entry? We need a credit. Well, we performed a service, so we earned revenue. We know that revenue has a normal credit balance, so to increase it, we need to credit it. Our journal entry then is to debit cash and credit revenue, since both cash and revenue increased. Our next step is to put this information into our T accounts. We debit cash, so the amount is entered in the left column. We credit revenue, so the amount is entered in the right column. Remember, in these T accounts, the left column is always debit and the right column is always credit. Now we're going to issue loan for some equipment, a capital asset. We need some equipment to continue providing our services, but we don't want to deplete our entire cash savings to pay for it. Instead, we'll issue debt. In this case, our capital assets are increasing, and capital assets are a type of asset which has a normal debit balance. So we debit capital asset to increase it. What else is happening in this transaction? We are issuing a loan. Instead of paying cash, we took out a loan. So we're increasing our liabilities. Liabilities have a normal credit balance, so to increase it, we need to credit it. This journal entry debits capital asset and credits loan payable. So notice the debits equal the credits, which must be true for all journal entries. Our next step is to fill in our T accounts. Capital asset was debited, so we use the left column, and loans payable was credited, so we use the right column. This time, the customer is billed for service. We performed a service and earned the revenue, but we haven't been paid yet. Remember, under accrual accounting, we recognize the revenue when it is earned, even if we have not received the cash yet. That means we will increase revenue, which we know is a credit. But what do we debit this time? We can't debit cash like we did in our very first journal entry because the customer didn't pay us. This time, we just sent them a bill. That means the customer owes us payment. When someone else owes us, That's an asset, accounts receivable. To increase an asset, we need to debit it. Our journal entry is a debit to accounts receivable and a credit to revenue. We then input this information into our T accounts. Accounts receivable had a debit, so we used the left column. Revenue had a credit, so we used the right column. For revenue, notice this is our second time recording a revenue, so the amount from our previous revenue transaction is already in our T account. Now we purchase some supplies with cash. We anticipate we'll use these supplies within the year, so we're just going to record an expense for this purchase. Expense accounts have a normal debit balance, which means we need to debit supply expense to increase it. We used cash to buy these supplies, which means we need to decrease cash. Cash is an asset, so it has a normal debit balance. That means to reduce it, we need to do the opposite. We credit it. So our journal entry is a debit to supply expense and a credit to cash. We then carry forward the information to our T accounts. In the first transaction, we received $6,000 in cash. So we put the $6,000 in the debit column on the left side. Now we are using up cash. We credit the cash account. So we use the right column to put the journal entry into the T account. When you read T accounts, you net the debits and credits. A $6,000 debit minus a $5,000 credit gives us a $1,000 debit balance in the cash account. That means right now we have $1,000 in cash. For the supply expense T account, we debit this account, so the $5,000 goes in the left column. Another customer is billed for service. This is the exact same as transaction 3. This time we charged $10,000 instead of $7,000. Maybe the job was more complex. We just repeat the steps from journal entry 3. Debit accounts receivable and credit revenue. We then carry it forward to our T accounts, and we see all of the past transactions are in the accounts receivable and revenue T accounts. Now we receive payment from customer number 1. We are getting cash, so we debit cash to increase it. What about the credit side? Well, the customer made their payment, so they no longer owe us money. Our accounts receivable balance needs to be decreased. To decrease an asset, we credit it. Our journal entry debits cash and credits accounts receivable. Then we carry it forward to our T accounts. Notice in our accounts receivable T account, we record the reduction as a credit in the right column. We do not delete the original entry in the left column. Each transaction is a new entry in the T account. Now we've had our equipment for a while, and it's time to make the first loan payment. This means our cash is going to decrease because we're paying something, so we know we need to credit cash. What about our debit side? When we make a payment, we will no longer owe that amount to the lender. That means our loan payable balance will be decreased. Loan payable is a liability account, which has a normal credit balance. So to reduce it, we do the opposite. We need a debit. When we borrow money, we also pay interest in addition to repaying the principal amount borrowed. That means we also have an interest expense here. Expense accounts have a normal debit balance, so we debit to increase it. Our final journal entry is to debit loan payable to decrease it, debit interest expense to increase it, and credit cash to decrease it. This is a good example of how sometimes one transaction affects more than two accounts. The important thing is that debits equal credits. We paid $1,000 on the loan for principal and $50 of interest. So the total cash outflow is the sum of those two items, $1,050. Again, we record this in our T accounts. We debit loan payable and interest expense, so those amounts get recorded in the left columns of the T accounts. We credit cash, so that amount gets recorded in the right column of the T account. Now we're at the end of the month, and we have a couple employees that expect to get paid for their hard work all month. Payday is scheduled for February 5th, but the employees have already provided their services, so we owe them for the work already performed. When we owe someone else money, we have a liability to report. In this case, we'll call it accrued wages. Sometimes it's also called wages payable. To increase the liability, we credit it, but we also need a debit. In this case, it's going to be payroll expense. We've incurred an expense because someone else has provided us a service, and we report expenses when they are incurred rather than when they are paid. So to increase the expense, we debit. Our final journal entry debits payroll expense and credits accrued wages, which is a liability. We then add these to our T accounts. This is the first time we've used these T accounts, so this is the only entry in them. Also at the end of the month, we need to record depreciation on our equipment. We purchased it for $6,000. Let's assume the useful life is 5 years, or 60 months. 1 month has passed, so we need to record 1 month of depreciation. To calculate this, we divide the purchase price of $6,000 by the useful life of 60 months to get $100 for 1 month. We need to record depreciation expense, and to increase an expense, you debit it. On the other side of the transaction is accumulated depreciation, which is a contra asset account. We want to increase accumulated depreciation. Normally, to increase an asset account, you debit. But remember, this is a contra asset account, so we do the opposite. To increase accumulated depreciation, it needs a credit. So our journal entry is a debit to depreciation expense and a credit to accumulated depreciation. We then carry this forward into our T accounts. Now that's it for our example journal entries. Let's take a look at how these journal entries get turned into the financial statements. We'll start by looking at all of our T accounts. These are a summary of all those journal entries we just did. This screen shows our balance sheet accounts, meaning the accounts that get reported on the balance sheet, which are our assets and liabilities. We net the debits and credits for each account to show a final debit or credit balance. For example, in the cash T account, we add all the debits of $13,000 and subtract out all the credits of $6,050. That leaves us with a debit balance of $6,950. And we do the same for the rest of our accounts too. These are income statement accounts, which are the revenue and expense accounts. So we net the debits and credits just like we did with our balance sheet accounts. Our next step is to input all of the ending balances into what we call a trial balance. A trial balance literally just lists each account and its balance. We want to double check that debits equal credits at this point. If not, something went wrong earlier in the process. Maybe one of our journal entries didn't balance, or maybe one of the transactions didn't get carried forward into the T account. In this case, our debits equal credits, so we're in balance. You can see here that all of our asset accounts have a debit balance, which is their normal balance, so that is good. We also have our contra asset account for accumulated depreciation. And remember, contra asset is like a negative asset, so we expect that one to have a credit balance. Our liability and revenue accounts have credit balances, which are the normal balances for those accounts. If any of these accounts did not have a normal balance, for example, let's say one of the expense accounts had a credit balance, that might indicate something went wrong somewhere along the way. Also, any negative amounts in here would indicate that something unusual happened, and we should investigate further. Now that we've reviewed the trial balance and everything looks reasonable, debits equal credits, and the ending balances of each account matches their expected normal ending balance, so we can move on. We start with the income statement. This is where the revenue and expense balances go. We start with operating revenue. We only had one revenue account, so we put the amount from the trial balance, which is $23,000. We list operating expenses, so we had the supply, payroll, and depreciation expense. Again, we are just pulling amounts from the trial balance. Then we calculate the net income. We also had interest expense on our loan, which is considered a non-operating expense. So this one goes below the net income line. Next comes our beginning net position. Now our beginning balance was $0. We're assuming we started the business this year. So our ending balance is $9,850. A few notes about income statements. These are showing the financial performance over a period of time. So the date needs to reflect that it covers a period of time. We prepared an income statement for 1 month. So our date was for the month ended January 31st. That clearly tells readers the time frame. It was only for 1 month, and it was the month of January. Most financial statements that are published cover an entire year, so those would be dated for the year ended 12/31, or whatever the fiscal year end is. The focus is on revenues, expenses, and other gains and losses. Our example included revenues and expenses, but other gains and losses, like investment gains and losses, would also be reported here if we had investment activity. In governmental accounting, we have 3 separate types of income statements. We have the statement of activities, which shows the activity for the entire government. We have the statement of revenues, expenses, and changes in net position, which shows the activity for the proprietary funds. And finally, we have the statement of revenues, expenditures, and changes in fund balance, which shows the activity for governmental funds. After preparing the income statement comes the balance sheet. This statement lists our assets and liabilities. The difference between assets and liabilities is reported as either net position or fund balance. Remember, in governmental accounting, we don't have owner's equity. To fill this out, we use the amounts from our trial balance. Notice that our accumulated depreciation is listed in the asset section as a negative amount. That's because it's a contra asset account, or a negative asset account, so it actually reduces our total assets. Another reporting option would be to combine it directly into the capital asset balance and report one line item called capital assets net for $5,900. We then list our liabilities, and net position gets calculated by subtracting those liabilities from the assets. At this point, it's important to double check that the net position on our balance sheet matches the net position from our income statement. In this case, they both report $9,850. Finally, on the balance sheet, we're going to add the liabilities and net position together. We double check that this amount equals the total assets. If it does, that means it balances. Here, they both report $22,850, so it looks good. A few notes about the balance sheet. This statement should be dated as of a specific date. Ours was dated January 31st because we were presenting our account balances as of January 31st. Most financial statements that you will see will be dated as of the end of the year. Now, this date is different from our income statements that are dated for the year ended, indicating they cover the entire period worth of activities. That's because when we think about revenues and expenses, the financial statements are reporting the revenues earned and the expenses incurred over that entire period. They are not just reporting the revenues and expenses from the last day. But for assets and liabilities, we actually are just reporting what their balance was on the very last day of the period. So that's why the dates are stated a little differently. The balance sheet focuses on assets, liabilities, and fund balance or net position. We didn't have any in this example, but deferred outflows and deferred inflows also get reported on the balance sheet. In governmental accounting, we have two types of balance sheets. We have the statement of net position, which is showed to use the assets and liabilities of the entire government. And governments actually prepare a second statement of net position just for their proprietary funds. And finally, they have a balance sheet for the governmental funds. The final statement we'll look at is the statement of cash flows. This statement is what it sounds like. It's literally reporting the cash inflows and cash outflows for the period. In our case, that period is 1 month, the month of January. Inflows and outflows must be reported on their own line. We cannot net inflows and outflows. The first section is the cash flows from operating activities, which is where things like cash receipts from customers and cash payments for supplies goes. We would also report cash payments to employees if we had any. In our example, we only accrued wages payable, but we didn't actually pay out any cash, so cash payments to employees in January was 0. Next is the cash flows from non-capital financing activities. This section would be used for grants or subsidies that were received that weren't restricted to be used for capital assets. We had none in this example. Next is the cash flows from capital and related activities, which is for all things related to your capital assets. We issued a loan of $6,000 and used it to buy equipment, which is a capital asset. So we had that cash inflow of $6,000 followed by an immediate cash outflow of $6,000 to purchase the equipment. So even though the net effect on cash was $0 because we took out the loan and immediately purchased equipment, remember that we cannot net on the statement of cash flows. So we have to report that cash inflow and cash outflow separately. Now we also made a payment on that loan, and that payment gets reported in this section as well. And we break it down between the interest amount paid and the principal amount paid. The last section is cash flows from investing activities, which is where you would report purchases and sales of investments and any interest income received. We had no investing activity in this example. Then you report the beginning cash for the period, which is $0 in this example because we're assuming the business started on January 1st. You add in all the cash flows, and it should equal the ending cash. If we go back to our balance sheet and back to our trial balance, we can confirm that the ending cash in our account was $6,950. We aren't quite done yet though. Now we need to reconcile the cash flows from operating activities to our net income and loss reported on the income statement. In this reconciliation, we're starting with the operating income or loss from the income statement, which is $9,900 in this example. And our goal is to reconcile this amount to the net cash provided and used by the operating activities from that first part of our statement of cash flows. Now, if you think about it, these amounts are actually reporting the same thing. They're reporting the results of operations. It's just reported on a different basis of accounting. The operating income or loss is the result of operations on the accrual basis, where the net cash provided and used is the results of operations reported on the cash basis. So this reconciliation requires us to think about the differences between cash basis and accrual accounting. Our first reconciling item is depreciation expense. So under accrual accounting, we record depreciation expense, which reduces operating income. But you don't actually pay out any cash. So depreciation expense is not included in the net cash provided and used by operating activities. So we have to unwind it from the operating income to go from accrual basis to cash basis. That means we're going to add it back in because we don't want it to reduce the operating income. Now comes the harder part, which is the accruals. In our operating income, we recorded $23,000 of revenue. However, we did not actually receive cash for all $23,000. Some of that revenue is actually from accounts receivable. But remember, our net cash provided and used by operating activities reports revenue on the cash basis. So that $10,000 increase in our accounts receivable balance, that's accrual basis revenue, but it's not cash basis revenue. So to go from that accrual basis to cash basis, we need to subtract out that increase in accounts receivable. Now our operating income was also reduced by $8,000 for payroll expenses, but we didn't actually pay cash for that. We accrued wages payable. We recorded a liability. So to go from accrual basis to cash basis, we need to reverse out that transaction. So that means we're adding back in that $8,000 of accrued wages payable since we didn't actually pay it out in cash. And now, when we add the adjustments and the changes in assets and liabilities to the operating income, that gives us the net cash provided and used by operating activities. And we can go back to the first page of the cash flow statement and make sure that the net cash provided and used by operating activities matches the amount from the first page. So on this page, our net cash provided and used by operating activities is $8,000. When we go back to our first page of the cash flow, we can see that it is also $8,000. That means that we did it correctly. To wrap up our statement of cash flows conversation, here are a couple main points. This one is dated for a period of time rather than a specific date. That's because we're reporting the cash flows for an entire month or an entire year rather than for just one day. It focuses on cash transactions, what cash came in and what cash went out. There are 4 sections to a governmental cash flow statement: operating activities, non-capital financing, capital and related financing, and investing activities. And this statement also has a required reconciliation to show how the operating income or loss relates to the cash flows from operating activities. That's it for the accrual accounting fundamentals and terms. So hopefully you feel more familiar with accrual accounting terms, the types of accounts used, like the assets, liabilities, revenues, and expenses, and how to use these accounts in journal entries. If you have any questions, please feel free to submit a help desk. Thank you.